Your phone buzzes, a notification. Your credit limit just went up. For a second, something in your chest lifts. It feels like a gift. It feels like proof that you're doing something right. But here's what's actually happening. That number was never a reward for good behavior. It's a prediction, a bet, calculated down to the decimal on exactly how much debt your brain can be talked into carrying before you notice the cost. Think about the last time you tapped a card at checkout. No cash left your hand. No wallet got thinner. The transaction took less than 2 seconds, and your brain barely registered it as spending at all. Did it feel like real money leaving your life? Probably not. And that gap between what you spent and what you felt is not an accident of technology. It's the entire business model. This didn't start with apps. The first modern credit card, Diners Club, launched in 1950 after a man named Frank McNamara reportedly forgot his wallet at a business dinner and had to call his wife to bail him out. Within a decade, banks realized something far bigger than convenience was at stake. A piece of plastic could sit between a person and the discomfort of parting with cash, and that small distance was worth billions. Every redesign since, the chip, the tap, the app, the one-click checkout, has been an engineering effort aimed at the same target. Shrink the distance between wanting something and owning it. Shrink it far enough, and the wanting barely has time to ask a question first. In 2001, researchers Drazen Prelek and Duncan Symester at MIT ran an auction where one group could only bid with cash and another could only bid with credit cards. The credit card group bid, on average, about twice as much for identical items. Same product, same value. Double the willingness to pay just because of the payment method in someone's hand. Prelek and Symester called this the credit card premium, and it revealed something uncomfortable. The pain of spending isn't really about your bank balance. It's about how spending feels in the moment. That feeling has a name. Behavioral economist Dan Ariely, working with Drazen Prelek, describes it as the pain of paying. The small psychological wince your brain generates when you watch money physically leave your hands. Cash produces that wince immediately. A card mutes it. A tap mutes it further. A stored card number, saved for one-click checkout, mutes it almost to zero. Why would a company spend millions of dollars removing friction from the last 3 seconds of a purchase? Because those 3 seconds are where second thoughts live, and second thoughts are bad for revenue. This is where mental accounting comes in, a concept from Nobel-winning economist Richard Thaler. Thaler found that your brain doesn't treat money as one single, fungible pool. Instead, you build imaginary folders for it. There's grocery money, fun money, rent money, and critically, future money. The money you'll supposedly have later to pay off what you're borrowing now. A credit card doesn't just let you spend, it lets you spend out of a folder that doesn't exist yet. It borrows from a version of you that hasn't earned the paycheck. So who is that future version of you exactly? And why does present you trust them so much? This is where the research gets stranger. Economist George Lowenstein has spent decades studying present bias, sometimes called hyperbolic discounting. In plain English, your brain values a reward right now far more than it values an equal or even bigger reward later. And it does this in a way that isn't consistent or rational. Offered $100 today or $110 in a month, most people take the 100 today, even though waiting is the better deal. Now flip it. A credit card offers you the purchase today and the payment next month. Present you gets the shoes, the flight, the dinner. Future you gets the bill. Because of present bias, your brain consistently, predictably undervalues how much future you is going to hate that arrangement. Here's a term worth decoding properly, a PR, or annual percentage rate. The yearly cost of borrowing money expressed as a percentage of what you owe. Average credit card APR sits well above 20%. That means a $2,000 balance left alone and only nudged along by minimum payments. The smallest amount you're allowed to pay each month without penalty, usually just enough to cover interest plus a sliver of the original debt, can take over a decade to clear. It can cost more in interest than the original purchase itself. 10 years. For a purchase that took 2 seconds to feel nothing about. Run the numbers slowly because they're worth sitting with. A 22% APR applied to a revolving balance compounds, meaning you don't just pay interest on what you originally borrowed, you pay interest on the interest that's already piled up. Compounding is why a debt can grow even while you're technically making payments every single month. Minimum payments are designed structurally to keep that compounding alive as long as legally possible because the interest is the product. The purchase was never the product. Have you ever looked closely at your own statement's minimum payment warning box? The one that shows how long full payoff would take at the minimum? Most people haven't. It's printed in small text for a reason. Now add "buy now, pay later" into the picture, since it's often marketed as the gentler alternative. Split a purchase into 4 interest-free installments, and the pain of paying, that same wince Ariely and Prilek identified, gets sliced into 4 smaller, even quieter moments. Less friction each time. Miss one installment though, and many of these services quietly convert into the same high-interest debt they were positioned against. The interface looks new. The psychology underneath it is identical to 1950. Now for the counterintuitive twist, you'd expect the people most likely to fall into revolving debt, carrying a balance month to month instead of paying it off in full, to be the ones who don't understand interest rates. Financially illiterate, in other words. But research building on Lowenstein's present bias framework has found something odd. Knowing the math doesn't reliably protect you. People who can correctly calculate compound interest still carry balances. Why? Because revolving debt isn't primarily a knowledge problem. It's a timing problem. The decision to overspend happens in a hot, immediate emotional state. Standing at checkout, scrolling a cart, tapping "buy now, pay later." The decision to regret it happens later, in a cold, calm state, usually while looking at a statement. 2 different versions of the same brain, making 2 different decisions. Only one of them was in the room when the swipe happened. Does that mean credit cards are simply a trap, full stop? Not quite, and this is the part worth sitting with. A credit card is neutral. It's a tool that amplifies whatever relationship you already have with your money. Used with structure, it can build your credit score, a number roughly between 300 and 850 that lenders use to estimate how reliably you repay debt, which affects the interest rate you're offered on everything from car loans to mortgages. Paid in full every month inside what's called the grace period, the window after your statement closes where no interest accrues if the balance is cleared. A credit card can function almost like a free short-term loan with built-in fraud protection. The tool isn't the trap. The gap between spending and feeling is the trap. And that gap is designed, tested, and optimized by people who study Prilek, Semester, Ariely, and Thaler's work professionally in order to widen it. So here's the practical application, and it has almost nothing to do with willpower. Willpower is what your brain uses in the hot, immediate state, the exact state credit card design is built to exploit. What actually works is reinserting the friction that technology removed. Before you tap or click, ask a single question out loud, even quietly. Would you still buy this if you had to pay cash right now? That question drags the purchase out of the frictionless zone Prilek and Semester identified and back into a zone where your brain can feel the cost. Consider turning off saved card numbers on shopping apps, not because you're incapable of self-control, but because you're a human being with the exact same present bias Lowenstein has documented in thousands of subjects. Consider setting up autopay for at least the statement balance in full, so Thaler's mental accounting trick works in your favor instead of against it. The money leaves the bills folder automatically. Before present, you get a vote. And consider checking your utilization, the percentage of your credit limit you're actually using, keeping it low, not just for your score, but because a card that feels almost maxed out produces a far more honest kind of pain of paying than one that feels bottomless. There's one more habit worth building, and it costs nothing. Reintroduce a delay, not a permanent one, just enough to let the cold, calm version of your brain catch up to the hot, impulsive one. 24 hours before a non-essential purchase over a set amount you choose. A day sounds small, but present bias, by definition, weakens with distance. The further a decision sits from the actual moment of wanting, the more accurately your brain weighs it. That's not a trick. It's the direct, practical flip side of everything Lowenstein measured in the lab. And it's worth naming what a credit card is not. It's not a measure of your worth, your adulthood, or your discipline. A limit increase doesn't mean a bank believes in you personally. It means an algorithm has recalculated how much risk it can profitably extend, based on patterns that have nothing to do with your character. Treating that number as a compliment is exactly the mental shortcut the system is built to exploit. None of this requires becoming a different person. It requires designing your environment for the brain you actually have, not the perfectly rational one economists used to assume existed before people like Thaler, Ariely, and Lowenstein proved otherwise. Your spending isn't a character flaw when it slips. It's a predictable response to a system engineered by people who understand your psychology better than you've had the chance to. So the next time your phone buzzes with a credit limit increase, notice what you feel first. That lift in your chest isn't your bank celebrating your progress. It's a number calculated by people who have read the same research you just heard, betting that the feeling will move faster than the thinking. Free money or a trap was never really the right question. The real question is whether you spend the next 30 days as the version of you who felt the swipe or the version who only reads the bill.